Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
The information in this episode is general in nature and does not take into account your personal objectives, financial situation, or needs. Nothing discussed should be considered financial, legal, or taxation advice. Before making any decisions, you should consider whether the information is appropriate for your circumstances and seek independent, professional advice from a licensed financial advisor.
And welcome back to another episode of the Defence Property Podcast. Pretty excited about today's episode. We've got a financial plan and that's really going to have hopefully some value bombs in there and just some real good guidance that we can draw on and include in our property plan. So we've got Matt Bazzica from Futurevest up on the Sunshine Coast. Matt, welcome to the podcast.
Yeah, thanks very much, Kane. Looking forward to having a chat.
Yeah, mate. So you're not ex-army yourself, but we want good quality advice and stuff for our clients and stuff. So we hold your value. I've known you for quite a while now and hold your opinion in high regard. So keen to get your thoughts and some guidance for our clients. So I guess kick us off and just tell us, about your background, even growing up, your story, and how you got into financial planning, and sort of what you do, day-to-day basis as a business.
No worries. So no, that's good. I've had my own practice for almost 20 years now. Been in the industry for a bit over that. From that point of view. So originally from Adelaide, now on the Sunshine Coast. Excuse me. We do have clients all over Australia, but got an opportunity actually through my father-in-law back many moons ago, and didn't know it was really something for me, but got into it and then learned the ropes from that point of view. And I guess as time's evolved and building relationships and got a really good understanding of how to build wealth, take action, property, so many different aspects from that point of view. So we help a lot of clients in that respect, and property is definitely a main focus of us from a cash flow and building wealth point of view as well.
Yeah, nice. So we'll just get into, I guess, I'm keen to hear your thoughts on that. I guess a lot of financial planners aren't typically pro property for whatever reason or not. Obviously I would much gravitate to the financial planner that is pro property, because I think it's an amazing asset class, but also I understand, I guess, having a holistic plan. So just talk us through your thoughts on where property sits in that broader plan that you would be working on with clients.
Yes, look, a lot of it comes down to like what are you trying to achieve? What's the end goal that you're trying to work towards? That's probably the most pivoting starting point for a lot of people is what's that retirement income look like? Or what's the cash flow that you want to generate to be able to do the things that you want to do and live the life that you want to live? And there's times where people just don't think about that. They don't have an answer. They're just sort of winging it, doing it day to day, and just sort of going by the the way of just how do we get around all this kind of stuff. So I always find that having a look at what's that end goal and what's all the bits and pieces that you need to look at. So from there, we then can work out, well, all right, what's the net assets that we need to build to generate the income that you want to live off? And say if it was $200,000 a year, we then look at their current situation, the surplus income that's available, and then, look at what's the different things that you need to do. Property is part of it. Diversification is obviously the key, but, there's been good wealth in property. A lot of Australians love the bricks and mortar. It's tangible from that point of view. So we like to have that as part of the portfolio involved. So the other thing is too, like, what are you trying to achieve from that property? Do you need to buy multiple properties to be able to generate the wealth that you want to create from that point of view, from the long-term strategy? Because, a lot of times in the market now, we're not necessarily potentially generating a lot of income from those investments, but if you're going to hold them for 10, 15, 20 plus years, well, what's the growth that's being achieved out of that? But then, it could be that, do you sell down some properties along that time frame as well? So by doing that, you then can potentially create an income stream by paying down the debt on those other properties. So I find the biggest draw card with property is like how many do you need to get to then get to that stage of the income that you actually want to generate. So it's then working out, well, as part of your overall strategy, how many properties do you actually need? So I think the majority of Australians generally will have 1 to 2 properties and they don't have much after that. So it's getting people to understand the mechanisms of, you know, it's okay to have more properties under your belt from that point of view to generate those strategies and the income and outcomes that you're trying to achieve from all of that.
Then what you said something that's so important, like um, identifying the goal, like having a goal that you're working towards. It's kind of like from a day-to-day life in the military, you might be going on a patrol or a vehicle convoy and not taking a map. Like how do you know where you're going or when you're going to get there and stuff? Like you got to have that destination that you want to achieve from a wealth and an income level, and then kind of just reverse engineer it from there, don't you? Like, and you could have, like, if you've left this till you're 45, you've got obviously a much shorter runway to launch, fly, and then land the plane at that destination. Versus if you give you starting in your 20s, time's our most precious resource, and then time's going to do I feel, all the heavy lifting in a portfolio if you get it right. But it's only going to do that heavy lifting if you've got that plan, that starting point, and that destination. Um, and I guess in defense specifically, like, I've lived the life, and defense certainly isn't the only career out there where people are typically very time poor, but they do go out to sea, for months on end, or they go outfield for multiple months or overseas, where they are typically quite constrained and restricted from, just emails and phone calls and a bit
Yeah.
and promotion courses are another one. Um, but in my eye, that's just not enough of a reason to not do it. Like, the the opportunity cost of not doing something can be so consequential. Just talk us through, like, your thoughts on opportunity cost and, the time poor professional, whether they're defense or, anyone in a very switched on world where everyone's time poor. Yeah.
Uh, And look, if you're on call and on duty and all that, then you can have some limitations. But at the end of the day, there's times when you're not going to have those limitations.
Yeah.
It really comes down to how big is your why and how quick do you want to get there. Because if you're going to take time to make decisions, most times you miss the boat. And I know with property, you need to make quick decisions to snap things up when the opportunity presents itself. And if you don't, then you've missed that opportunity. So, we had some examples prior to COVID where some clients had equity. We wanted to use that equity to then go and get their next investment property. And we had a few of them where they just stalled and didn't take any action. And we know how much property went up over that time frame. So they actually missed the boat on that. And they now openly, admittedly say, yeah, we should have taken action. We can only do so much. But at the same time, if you take action, then things start to move, especially when you're young. Like you mentioned before, if you can get your foot in the door and start your wealth creation journey early, it's so much easier on the back end. And, if you were to start early at a younger age, you don't know, you might get to the stage, you might build up the right assets that producing you a passive income that you can stop working at such a younger age instead of having to work at age 65.
Yeah.
So if you're going to sit on the fence and not take action, then you're going to get the outcome of not taking action. It's quite simple, really.
100%. And if you want results beyond the average, you got to be willing to do what people aren't, average people aren't doing and stuff. And it's not only just taking action, but following the plan and sort of executing it and stuff. But you sort of, like, we saw heaps in that. You mentioned that post-COVID property era. Like, I remember some people, like, sold, 2021, 2022. They might have had that property for 5 or 10 years with the intent to, upgrade or buy again somewhere. And just that, that lack of knowledge of where the market was at, what it was doing, and then that getting back into the market because it moved so aggressively in so many areas. Like, we were talking some areas 22. I remember buying in South Australia and 22% a year, but in South Australia, and this would have been 2022. I put in an offer for a client. There was 36 offers in the first weekend.
Yeah, wow. Yeah.
it's-
And it was pretty aggressive like that at the time, right? And most times people were just putting in overs just to get something. So Um,
It was astronomical sort of growth and market heat and stuff. But that's that opportunity cost of, people that took action and got into the market, obviously rewarded very handsomely for that. But, people that didn't or sat in their hands, like there was many people that said, I'll just wait and see where it goes. And they were punished. And there was just other people that weren't in a position to take action that made life a lot harder for those people. Um, but I kind of feel that there's always opportunity, and looking back isn't like it could have been better, but it could have been a lot worse as well. And if you've got the time and the runway to start investing, you always should.
yeah, definitely. And it's getting the right advice,
Yeah,
having the right sort of strategy behind in terms of what is it that you're trying to achieve. You got to start somewhere, and the later you start, the harder it is from that point of view. So even if it's you're not in a position to do something straight away on a property, well, what is it that you need to? Where do you need to be to get to that outcome to get the next property or get your first property?
yeah,
So reverse engineer and work out what you have to actually do to get there to then go and get the next one. And then I guess, getting the right advice in terms of buying the right property so you can generate equity, in the early stages of that property to then go and get the next one and the next one. So important.
yeah, definitely. And where does from a client comes on board with Futurevest, you're looking at obviously in some capacity, whether it's an investment or a home. But what else are you looking at as part of that holistic sort of wealth plan?
Yeah, look, there's a wide range of different things to look at from that point of view. I guess again, like it really comes back to what is the end outcome that we're trying to achieve? What are the returns? I guess we also need to achieve to get to that end income, and then from there work out what are those different types of assets to look at. There's private equity involvements. There's obviously property as part of that creation. There's a lot of different things that we can invest in from that point of view to try and generate different returns from different type of asset classes. I'll generally find though that ideally we want to get to the stage where if we can replace the income that you require through assets providing passive income, then at the end of the day, your investments are working for you to provide that income that you need. So even though property's part of it, there's a lot of different aspects and different things that we can invest in. But it's more of like, what's the end goal? What's your time frame? What's the returns we need to get to that end goal? Because that'll help identify, I guess, the risks you may have to take.
Yeah.
And then that individual's got to be comfortable with, are you willing to take those kind of investment risks? Like obviously at the moment, the property isn't in a downward market. It already was, but that's just part of a cycle. It's a long-term strategy. You're not buying for 12 months to then, get upswing and get out.
Yeah.
So it doesn't matter. I mean, now there's great opportunities from that point of view. The share market's doing well, but the share market goes up and down as well, right?
Yeah. And if you weren't looking to sell now, what does it matter if it's gone up and down? Like if you bought a property in the last 5 years with the intent to hold it 20, who really cares about now? Like what it's done in the last 3 months. Like it's irrelevant in that big picture.
It's irrelevant. And then, if you've got a 20-year strategy on your property and you've got 17 years to go, like, because it's come back a little bit, you shouldn't be panicking and stuff. At the end of the day, you should have really run your numbers correctly to make sure, well, how's it impacted with interest rate movements? Can you still manage the cash flow on that? So, yeah, because at the end of the day, in 17 years, if you go over history and, can't guarantee returns, but generally they say property doubles every 10 years. So if you've got 17 years left of your 20-year projection, I dare say you're going to be in front.
Yeah. And this current market is potentially going to help the cash flow position of property anyway. But there's, I know the Labor government mentioned $2 per week rent. I'm not sure where they were doing their modelling for that with these changes to negative gearing and stuff. But if demand's equal and the supply of just investment stock has dramatically decreased due to these policy changes and stuff, I see that there's going to be huge rental pressure on rent prices. And if you are holding property, I'd expect that you could potentially, or your holding cost is drastically going to decrease with that rental increase over the next few years, hopefully.
Yeah, I'd say there's a fair chance it's going to play out. I'm just wondering if someone actually keyed in a different digit that they missed when they were modeling that $2 increase in rent. Because the reality is, if you're going to, Yeah, exactly right. So, but if you're going to take away certain benefits from an investor with property, you generally will find that the owners that those costs are going to get passed on to the renter.
Yeah.
That's just a given, and it's happened before in previous markets. So I think the government are kidding themselves if they think that by doing this is going to help first home buyers get into the market, because it's really not that part of the market that's being affected too much. It's more the higher end, and investors are going to get some much better yield returns because rents will naturally increase because people have lost some of the deductions that they can claim. So therefore, they need to make that cost effective for them to hold that investment.
Mhm. Bit of a change in direction. With like there's a lot of young soldiers, Sailor airmen in defence and stuff. And if I reflect on myself, I was always, keen to build wealth, and it was always like property was my channel and part that I just obsessed over. Um, and super was just this thing in the background that I knew it was for for me when I was 65, 67 or whatever, but I wasn't really interested in it. But if I look back and I understand a lot more about just, the share market in general and ETFs and what super is and where it fits into that bigger picture. But 20-year-old Kane had no idea and wasn't really interested in it. What advice would you give to someone that isn't, they're in their 20s, it's not really paying too much attention to it? Because I look back now and, you know, even though I was in a very basic fund that I wasn't a self-managed super fund, I guess is what I'm saying. I couldn't, I could only make very limited choices about, you know, what it was doing. And even then, those very limited choices, I was wrong, because I was just in the default setting. What advice would you give to because this comes into that, I guess, the opportunity cost that I look back and, I missed out on performance and growth of my fund because I was allocated wrong. And it didn't perform as well. So yeah, how can people be more aware and um what advice would you give them?
Yeah, it's a good point. I'm guilty and put up both hands. I didn't really pay too much attention to it in my 20s, even though I think I was about 21 when I got in the industry. But it's just one of those things you just, or whatever, it's such a long time before I can touch it. Why worry about it? But really, if you actually get on top of it in an early stage, you can actually make some good runs with it.
Yeah.
It's important to have a look at where the investments are invested. So, how much percentage exposure do you have to growth assets, which is like your shares and listed property and so forth, compared to cash and fixed interest? Look, long term history shown that your growth assets are generally going to make a better return. So, while you're young and you've got time up the sleeve, you might want to take a bit more risk and have a higher allocation to those asset classes because generally, it's shown that you will get better returns from what history has shown. I know it's not a guarantee of future performance. But generally, if you go back and look at all those charts, that's where you should be. Look, superannuation is really it's a tax minimisation vehicle to some respect. Since we're all potentially going to be paying more tax with all these budget proposals, there's ways to look at how can you leverage by putting a little bit more away into your super, get it to that end balance that you need it to be. Um, and also too, it can help reduce potentially a little bit of your personal tax.
Yeah.
So there's different wins there, but yeah, it's because it's such a I can't touch it for so long. It's actually important to just actually go in and have a look and just see where your money is actually invested and how it's invested. And are you comfortable with the level of allocation to growth assets? Because they do go up and down, right?
Yeah, yeah, definitely. And so for someone that's listening, like, would we just encourage them to reach out to yourself, or what options do people have? Like, if we've, just highlighted the importance of being aware of their super, but they're like, this is well above my level of knowledge or whatnot. Just reach out, and is that something that you can help review? And
Yeah, we can. I mean, if people want a bit more of a knowledge, we can reach out and have a general conversation around it. From that point of view, yes, we're more than happy to help. But initially, they can just at least log into their super fund and just
yeah,
have a look at it. It doesn't hurt to just get a bit of an understanding on your appetite to your risk profile, whether it's high growth, balance.
yeah,
Probably wouldn't want to go any less than that if you're young, because you've got time up your sleeve. Because if you go conservative, you're just not going to make high returns.
yeah,
But I understand someone that's at the pointy end or into retirement, as much as they want to build and grow their portfolio, they don't want to risk it too in case the market does have a correction.
Yeah, yeah, definitely. And I guess it really just impacts like what other assets you do or don't have outside of super as well. And just it's that one slice of the bigger pie, I guess, that's working towards your future retirement and stuff and income.
Yeah, definitely. And it's still important to, because obviously there's rules and restrictions with money going to super. So there's a bit of a fine line of where you want to allocate and how much you want to allocate into super. But at the same time, I mean, you can't buy a self-managed super fund with a residential property with a loan attached to it now. So that's limited people. So now you've got to go, well, all right, well, how do I get myself in a position where I can get my foot in the door to get that first property? Because once you've got your foot in the door and you've got that, eventually over time, you're naturally going to get equity in that property.
Yeah.
And then you can continue the journey where now we've been hamstrung a little bit by able to use self-managed super funds down that path. And there's only so much commercial property that can be bought, right?
Yeah. Yeah. And I think it's a completely different world as well. Like, obviously, people have probably heard me bang on about buy one property, pull out some equity, buy another, and just leverage and that is kind of like that snowball effect of building the portfolio, and obviously having a good broker and debt advisor on board in that A team. But super, and I've got a self-managed super fund, and had property and stuff. Like it was a different set of rules. Like you couldn't just pull equity out of one property in your super fund and go buy another. It was literally to release any gain that you've made over a period of time, you had to sell it, to then roll it in, like sell it and then split up the proceeds to then go buy two. There was no other way. So it was definitely probably a slower method, but it was a way.
Yeah, definitely. Because you can't use the equity in the property in the super, so it's definitely a different strategy. But we've been referred a lot of people where they've come to us and they've already got property in a self-managed super fund. But you're right, it just comes down, I guess, what you're trying to achieve, because there are some limitations. I suppose the only real benefit is you don't pay capital gains tax if you sell it in retirement phase. But if you got 30 years up your sleeve, that's a long time between drinks. Where is that going to get you the growth that you need in those properties? And you're right, leverage is king. I heard that when I was really young, leverage. And that's what the rich do. They leverage their wealth creation by using it from the banks.
Yeah. Leverage with compound growth is the eighth wonder of the world.
Yeah, definitely. So, and you mentioned before too, Kane, like having your A team, like making sure you got the right broker that knows how to set it up correctly, getting the right accountant to have the right ownership structure up front. Because sometimes, accountants, they love getting tax deductions, right? But it's like, what are you actually trying to achieve out of this end goal? Because if you've then got an asset that's doubled in value and it's now, will potentially, if it's already purchased, 50% gain, but potentially 33% gain. But, there could be $700,000 split over, say, a husband and wife or a couple. That's a lot of money in tax. But if it's just in one person's name, might have been a good tax deduction along the way, but not necessarily great on the way out on the exit strategy, because they've got all that gain to that one individual.
Yeah, definitely. And I think you touched like an important point there about your A team and stuff, and having the appropriate advisor that can guide you in navigating wherever you want to go with your portfolio, but also understanding their roles. Like obviously an accountant's role is to minimize tax, but to minimize tax, they're essentially trying to minimize income. But then a broker's going to say, well, you need more income, so you need to pay more tax so you can borrow more to buy another property and stuff. So it's kind of having enough knowledge across, your different members in your A team, I guess, and who's going to play that I won't say captain role, but and ultimately I feel there is an element of responsibility and knowledge that would fall on, the person that's actually buying the assets, and that to understand each person's role, but then, to make sure they're all working off the same sheet to make sure that you're on the same plan and you're going down that right path for whatever your goal is in your time frame.
Yeah. Look, collaboration's critical. If we want to go and do something, we'll go to the accountant and say, this is what we're looking to do. Ownership structures, like, is it going to affect the tax deduction, or, is there implications that's going to make our clients pay more tax? So, and you're right, like with the broker, you need more income because you can borrow more. So it's making sure everyone's on that same page to say, hey, this is what we're trying to achieve. These are the levels and different scenarios and where we need to go. How does a client's situation need to look to make sure we can continue to move forward on this strategy?
Yeah, lovely. So you generally have quite a few clients that are bullish on property and building multiple property portfolios.
Yeah, definitely. I'd say the majority of our clients have property. Look, we purchased a small book some years back, which there was a lot of properties in self-managed super funds from that point of view. Look, I've done quite well out of property. I got my first home in 2000, I think it was. And it was just at the right time before a property cycle. I know some people might be lucky and get in just before a cycle and make a ton of money. Some might take longer, but if you're in the game long enough, you're generally going to come out financially quite well having property in your portfolio.
Yeah. So what advice can you give to someone that's thinking about starting, but they're not sure where the start line is and where they are? And yeah, what advice would you give someone that's obviously thinking about this but hasn't really got that plan?
Yeah, no, it's a good point. You really just got to take action. I mean, reach out to you guys, have that conversation. Um, and then I guess you guys can lead them in terms of, all right, well, let's find out what your borrowing capacity is. Where do you actually stand? And then that way it allows that person to then make an informed decision of, hey, I'm not quite there, or yeah, you are there. And then from there, it's either working out, well, where do you need to get yourself to be able to then start that journey? Or if you are there, it's then like, all right, well, this is how the process works. This is what's involved. Then obviously finding the right property, knowing your numbers is critical.
Yeah.
Because that tells the story of what you're purchasing, right?
Yeah. And I
Um,
would encourage that conversation earlier if possible. Like, one, if you're not ready, they're going to guide you to where you need to be ready, to make that first purchase. But a lot of people are well past ready. They're sitting on really good savings, and a lot of people, like the 20% example, you don't actually need 20% deposit anymore these days. Like, there's so many options out there, from first home guarantee scheme, the government share scheme where you can buy literally 60%. And I'm probably not a big fan of that one because you're giving away some growth. But
yeah.
if that's the scheme that's going to get you in the market sooner and get that market growing for you, it could be, the best thing for you. There's just so many schemes out there that were never available, even 10 years ago, definitely 20 and 30 years ago. It's a lot of people can be past the point of being ready to actually do something and not be aware of it. So if anyone listening, I really encourage that, just reach out to someone. Like, we'll definitely connect you with the right people. If you've got a planner or a broker, have that conversation early.
And I suppose it's being educated to ask what needs to be done. Like,
Yeah.
I always say to people, it's better to find out what position you're in, and then we can make an informed decision of where's the next steps. Because if there is a shortfall, and sometimes there is, it's like, well, all right, here's the gap, but now we know what we're working towards.
Yeah. And what about budgeting when someone is in that savings mode? What sort of high level budget tips could you hand down to someone that,
Um,
that
it's
might
probably
not
one of
be
the
responding
it's
to
probably one of the worst areas of people's situations, to be honest.
Yeah.
Uh, I mean, there's plenty of apps out there, or you can go to the Money Smart government website and get the free. There's a free expense planner on there, and you can just itemize all of it. Or there are some apps where it'll actually data feed your bank statements and then categorize all your expenditure, so you can understand where your money's going. I think the biggest thing is, sometimes people don't know what they're actually earning. So
Yeah.
you need to know your numbers. It doesn't matter if you're a business. Because I say to people, if you were the CEO of your own finance company, would you sack yourself? And most people would, because they're doing a pretty poor job of it. But understand the income that's coming in, look at where your money's going, and then you identify, one, where can you shop around, and try and get something cheaper that you're paying for, or two, where are you wasting money? I find clients where they've been just sort of spending here and there and everywhere. Once they actually get a bit of a system in place in terms of giving structure to their income, they actually start being more conscious of, do I actually need to buy that?
Yeah.
And and probably as we're younger, we're more prone to just wasting and buying stuff we don't need.
Yeah.
But I found when clients actually have given that the structure it requires, they actually can start seeing the savings that's being had, and they get excited to the extent that they try and build on that even more because they're actually saving money. Like we had one couple that had about 8 or 9 different debts. We ended up getting it down within it was about a year, getting it down to 2 debts, and then in 18 months' time, they were ready to buy an investment property.
Yeah. Wow. That's
They
amazing.
were just wasting money on so much stuff; it was ridiculous. But it's really just identifying, and I think sometimes people don't want to do it because they don't want to see what they're spending their money on. But just put that aside and actually know your numbers and see where the money's going, because really you want to be allocating some of that towards wealth creation.
Yeah. And it's like that saying, whatever you measure, you manage, So if you're paying attention to it, you're just going to cut back a little bit. And it doesn't have to be monitoring every single spending. Like there's so many good theories out there on budgeting, like the 50-30-20, 50% to fixed bills, like bills, expenses, rent, mortgage, whatever, 30% on lifestyle. Like, yes, you can spend some, and then 20% on investments. And then depending on where you're at, you might already have a few investments and not need 20%. You can dial that down and dial your 30 up or down. And, depending on if you've recently purchased, the 50% might be closer to 55 or 60. But at least having some sort of system in place and segregate your accounts to make sure you're not, essentially spending more than you earn, because that's the fastest way to go backwards.
Yeah, I definitely. It's just I just find when you give money structure, it works for you.
Yeah, 100%. And I don't think, like, I literally sat down with my wife earlier this week and said, oh, it's about time we review. Like, I can't remember the last time we reviewed the budget, and, spending normally does, you know, have lifestyle creep. Do you know what I mean?
Yeah.
You spend a little bit more when you start earning more, and you're like, holy hell, we're earning this much, and, where's it all going, sort of thing. And that's a very typical scenario for, like, the defense force. Like, I've just been promoted. Like, there's one career in Australia where you can have a pretty well defined career path. With that career path comes, income progression, I guess. But normally, first promotional, I'm earning an extra so much. It's very easy to spend that as well. So, like, and it's okay to spend some, I would say, but be aware, like, if you're earning an extra $1,000 a month, fortnight, whatever, um, don't spend it all. Obviously, some of it can go to that spending allocation, but some should go to fixed bills, expenses, and some should go to your investments and lifestyle. But
Yeah. Oh, it's so true. And a lot of people, their lifestyle adapts to as their wages increase. Where if you can identify what's that end retirement age, what's the income that you need to generate from the assets
yeah,
from that point of view, um, by putting a little bit of that away earlier, you'd be surprised when we look at projections when eventually you get that compounding interest effect and people go, wow, that's actually increasing really good right up towards the end. But if you can start early and just punch away at it, you're setting yourself up for a better retirement, or if not even pre-retirement as well.
and like if you are recently promoted or something, you might have a 10% bump in your overall income. Like, allocate half of that as immediate contribution to super, and you're not going to ever see that money. That can be a huge sort of, especially if you can maintain that current lifestyle you got when you get promoted without spending anything extra. Allocate some to super, some to savings outside, and you can do quite well because of that compound effect over time that you mentioned.
Yeah, definitely.
Yep. And any final thoughts, I guess, or anything else we haven't covered that would be worth mentioning?
Oh, Kane, look, you could talk about all different things. There's so many different topics, but um, I guess if I can give one encouragement towards people is you take action, you get the results.
Yeah.
Do a little bit of research, make yourself a bit savvy. There's plenty of podcasts out there. There's plenty of stuff on YouTube to give yourself just enough nous to know that you're being led down the right path. But have a think about what's that end goal.
Yeah.
Now, you might not necessarily have the skills to be able to reverse engineer it, because how do you minimize tax? How do you pay down personal debt faster? Do you have your estate planning affairs in order? Your super, wealth creation, asset protection. There's so many different components with the whole strategy to get there. But at the same time, reach out to an expert if there's certain areas that you can't leverage off, or you're just not sure how to get there. But at least have a think about what's the end goal, and there's your starting point, and then work out whether you're on track. And then from there, it's a matter of like, we'll go and speak to you guys and professionals to get the right advice to build that wealth to get to that end goal. So
100%. And it doesn't have to be 67. Like, if you do nothing, it's most likely, from a retirement point of view, yes, it will probably be that 65, 67, 70, even worse. But if you start early and you do get a bit of a plan in place and identify what it is you're actually, achieving, it can be a lot shorter than, I'm sure you could sit here and rattle off so many people like I could that have retired much earlier than, because they've built solid investments over time. And yeah, I'm always going to say property is going to do the heavy lifting for that. But just investing young and that compound over time with a little bit of safe leverage can shave years and years off that
massively.
number.
Yeah. Time is your biggest winner when it comes to investing and building wealth.
Yeah. It's the most valuable resource. It's the only thing that we can't get more of.
Yeah, definitely.
Where can people find you if people want to reach out, Matt?
You can reach us on the Futurevest website. There's a contact page on there, or on LinkedIn or social media. But generally, you can go to the Futurevest website. And we're happy to have a conversation with people, even if it's just pointing in the right direction on where to go.
Yeah. And everyone should be able to find me at discoverbuyersagency.com.au or on socials. Reach out. Always happy to connect anyone, whether that is with Matt himself. If you want a conversation with me or even a mortgage broker, I'm always happy to connect anyone that we can. Matt, it's been great. We have to do this again and talk through more things, property, regular feature maybe. Thanks for coming on the podcast.
Yeah, no worries. Thanks for having me. You're right. There's so many different topics you can definitely talk about. I know we only just scraped the surface, but just take action and build your wealth.
Yeah, perfect. Love it. Thanks. And thanks for listening. Till next week. That's another episode of the Defense Property Podcast.